look, it was obviously a crazy couple days, and ETF flows show that the most outflows in a week in over a year, right? So that's that number, 11 billion there. But first, let's look at the inflows. Some stuff did take in money. Really, two areas, Vanguard and safe havens, right? You see the V's in here. Vanguard investors still plow money. You cannot shake them, so that's expected. And then the safe havens also expected. GLD, there's treasuries, you've got low vol and treasuries and staples. So the places you expect people to go when they're scared. Let's look at the outflows. Now, this is where things get kind of interesting. And really, it was, I'd call it a bloodbath, especially in the trading crowd ETFs. Look at SPY, 15 billion. That's the most since Volmageddon, right? HYG, 3 billion out. That's its most ever in a week. EEM, right? All the usual suspects, which brings me to the chart I love to show, which is traders versus allocators. And they were in tune for many months, since Halloween really, but they've now divided. The traders are spooked, right? Obviously, coronavirus has them running for the hills, but look at the allocators. They're holding strong. So that's a good sign. So Scarlet, as long as that blue bar there is secure, mom and pop is still buying. That's a good sign, but it's been a rough couple days.
Well, they've been trained during the last couple of years to buy the dip, and that's what's been happening. Let's bring in Dan Russo. He's Chief Market Strategist at Chaikin Analytics. And we also want to welcome Vildana Hajric, a cross-asset reporter for Bloomberg News. Dan, you heard Eric's take. Do you see a similar divide between traders and allocators as well? I wonder what you're hearing from clients and how you're advising them.
Yeah, it's an interesting point. I think the trading crowd really over the past few days, you've seen this kind of waterfall decline in the market. And really, I think the key level for the S&P 500 was 3250. When 3250 was taken out, that was a key technical level that led to more selling. And now we're kind of looking for a floor or an area where buyers might step in. We're getting a little bit of a bid to the market today. You kind of have this support area between 3,000 and 3,100 for the S&P 500, which interestingly holds the area where we broke out in October at about 3050. That lines up with the 200-day moving average and is also roughly a 10% correction from the recent highs. So I think traders who have to manage risk in the short term, yeah, that's what we're seeing. And allocators are using the opportunity to put capital to work in some of the leading funds.
All right, so Dan talks about technicals, and certainly that's a catalyst for people to do something, Vildana. But if allocators are staying put, and we saw that with those V tickers, the Vanguard funds, what's the narrative for those who are selling?
Well, we've often heard this argument that this bull market has been the most hated bull market of all times. There's always been this group of skeptics and investors who have doubted that stocks can continue to go up, and they've instead argued that really it's been the Federal Reserve that's been propping up asset prices. And so when we started to see stocks sell off so violently at the beginning of this week, we saw a lot of those investors rushing for the exits. At the same time, arguments that the Federal Reserve once again needs to step in and cut rates. We're hearing a lot more of those arguments, and the situation is just so uncertain that a lot of investors are coming out and saying, I'm not sure how effective a cut might even be considering the uncertainties around the virus.
So Dan, I asked you to bring some ETF picks, ETFs you're recommending your clients. Now, we talked when the carnage was happening, and you said, look, we still like growth. There's growth, communications, tech, even semis. A little gold there, but let's talk about those four. You still like growth even after what we've seen? Are you holding strong with those?
I do still like growth because I think what's happening is investors are beginning to discount a slowing global growth environment. And we're of the view that in that type of environment, you'll pay a premium for what actually is growing. So at Chaikin Analytics, we've been highlighting the Vanguard S&P 500 Growth ETF, which in our ETF model has a very bullish rating. It has more bullish stocks as holdings than bearish stocks, and it's been outperforming the market. And if you look at it, it's really been outperforming value. Again, speaking to the fact that in a world where growth could be scarce, you're willing to pay a premium for growth. I think the natural extension of that is technology, right? So if you look at something like XLK, also a very bullish rating. Again, part of that growth over value dynamic and just looking for growth in a potentially slowing growth world. And from there, I think you made a great point about it being a hated bull market, because one of the other themes that you're seeing is kind of this barbell approach, right? Where investors are bidding up growth, they're bidding up areas like technology, but at the same time, they're going into the safe havens, like you mentioned. So if you look at something like the utilities ETF, XLU, right, is outperforming the market. It has a very bullish rating in our model, and it's very similar to what we saw really for the first 3 quarters of 2019.
So it's a little bit of a barbell approach there. Vildana, I want to pick up on what Dan was saying and talk about tech here, because yes, it's obviously a growth sector, but at the same time, It can also be seen or interpreted as a safe haven because that's certainly what we got a taste of earlier this week as well.
That's what I'm hearing a lot from investors I speak with. So if we think about XLK, for example, its top holdings are Microsoft and Apple, some of these really high-flying names that have been rallying for months and months. And so one investor I spoke with said investors are looking at these names and they're thinking of them sort of as a defensive or a safe haven play because of their really strong balance sheets.
This is interesting to me because XLK has almost doubled the S&P over the past 12 months. Given that level of outperformance, you still buy it. I mean, just talk me, it goes against intuition that you would still want to own that even after that run. You think it has legs?
Well, I'm a believer in the momentum methodology, right? And I think really you have to take a step back and say, what kind of investor am I and what's my time frame, right? I think if you've been overweight technology, it makes sense to continue to be overweight technology. At one point last week, I was looking at the relative relationship between XLK and the S&P 500, and it was 3 standard deviations above its 200-day moving average. So do I necessarily want to chase it there? No, but if I'm thinking out over the next 6 to 9 months, if I'm looking at the rating within our model, if I'm looking at the ratings that we have on the underlying holdings, then yeah, I'm happy to be overweight technology.
Very quickly here, you also had a gold ETF on your list as well. How does gold fit in here? Because it started catching a bit at the end of last year and it went up even as stocks went up. So it's not exactly a perfect hedge anymore.
It's not a perfect hedge, but I think it speaks to that slowing growth dynamic that we were talking about. I think there's a level of uncertainty around the global economy. So people still want exposure to the equity market via growth and also some of the defensive areas. But at the same time, they recognize that there are these risks out there. So they've been flooding into funds like GLD for that exposure.